Are you feeling the pinch of the current recession? With everything going down, finding a stable investment can make it feel like searching for a needle in a haystack. But what if I told you there's a way to protect your portfolio and even earn a consistent income amidst all this market chaos? In today's video, we're diving deep into the two powerhouse bond ETFs that have been gaining traction among savvy investors looking for stability and income. But which one should you choose? One of these ETFs offers straightforward exposure to long-term US Treasury bonds, while the other employs a unique strategy to enhance income. Both have their unique advantages, but understanding their differences can be a game changer for your investment strategy. With the economy in recession and stocks plummeting, you need reinvestments and investments that can weather the storm. Imagine investing $100,000 today. After 30 years, one of these ETFs could potentially grow your investment to over $3,700,000 and provide a steady stream of dividend income, $3,600,000. Significantly enhancing your financial stability. For example, one of these ETFs has a current yield of 15.54%, which could generate substantial income over the long term. In the next few minutes, we'll break down these ETFs, compare their performances, and help you decide which one fits your investment goals. These numbers could make a significant difference in your returns, especially in these volatile times. Stick around till the end because it'll also share some expertise and expert tips on how to navigate your portfolio through this recession. Hit that subscribe button and ring the bell because you don't want to miss this. iShares 20+ year Treasury Bond ETF, TLT. The iShares 20+ year Treasury Bond ETF is a popular investment vehicle managed by BlackRock designed to provide exposure to US Treasury bonds with maturities greater than 20 years. As of August of 2024, TLT is priced at approximately $95.91. The ETF offers a yield of 3.75%, which is attractive for income-focused investors looking for stable returns in a volatile market. TLT's expense ratio stands at 0.15%, making it cost-effective compared to other funds in the same category. This low expense ratio ensures that investors retain a higher percentage of their returns, which is crucial for long-term growth. The fund has shown significant, and I mean significant, inflows, with $1.33 billion added in the past month of $15.57 billion over the past year, reflecting strong investor confidence despite market uncertainties. The performance of TLT is closely tied to interest rate movements and Federal Reserve policies. The Fed's indication of potential rate outs in 2024 could have positively impacted TLT by increasing bond prices as yield falls. This expectation has already led to a price increase of over 20% from its low point during the historic bond market downturn in October 2023. A key metric for TLT is its duration, currently at 16.67 years, indicating high sensitivity to interest rate changes. This means that TLT can provide substantial returns when rates decline, as evidenced by recent performance spikes following positive announcements from the Federal Reserve. For investors looking for long-term growth, TLT's 5-year compound annual growth rate is around 3%, reflecting its performance over a medium-term horizon. This balance of capital appreciation potential with the stability of US Treasury bonds makes TLT a viable option for those seeking both growth and security in their investments. TLT's portfolio is concentrated, with the top 10 holdings accounting for nearly 50% of its total assets. This concentration can be a double-edged sword, providing stability but also making the fund more susceptible to specific bond performance. The fund primarily holds US Treasury bonds, including notable holdings like the United States Treasury bond 3.0% maturing in the 2048 and the United States Treasury bond at 3.375% maturing in 2048, each comprising over 3% of the fund's assets. In terms of income, TLT distributes dividends monthly, providing a steady income stream for investors. The annual dividend rate is currently $3.59 per share, translating into a yield of 3.75%. This consistent payout makes TLT a reliable source of income, which is essentially beneficial for long-term investors seeking regular cash flow. The ETF's performance has been resilient in the face of market volatility. Despite a year-to-date performance of, minus 2.5%, the fund has shown the ability to rebound and deliver strong returns as market conditions improve. This resilience, combined with strong inflows and consistent dividends, underscores TLT's appeal as a core holding for many investors. In conclusion, the iShares 20+ year Treasury Bond ETF stands out as a compelling option for investors seeking exposure to long-term US Treasury bonds. Its low expense ratio, attractive yield, and significant inflows highlight its strength and investor confidence. While sensitive to interest rate changes, this potential for substantial returns in a declining rate environment, coupled with its steady income stream, makes it a solid choice for both growth and income-focused portfolios. For those looking to balance risk and reward in their investment strategy, TLT offers a reliable, robust option. iShares 20+ year Treasury Bond Buy Right Strategy ETF, TLTW. The iShares 20 plus year Treasury bond buy right strategy ETF is an innovative ETF managed by BlackRock that seeks to enhance income by employing a buy right strategy. This involves holding the iShares 20 plus year Treasury bond and writing 1 month out of the money call options on these holdings. Launched on August 18, 2022, TLTW offers investors exposure to long-term U.S. Treasury bonds with an added income component from the call options. As of July 2024, TLTW is trading at $26.28 per share with a net asset value of approximately $997.83 million. The fund has an expense ratio of 0.35%, slightly higher than some traditional bond ETFs, but justified by the additional income generated from the call options. The fund has seen significant interest rate due to its unique strategy, with 25 million shares outstanding and a 30-day average trading volume of over 626,000 shares. TLTW boasts a high dividend yield of 15.54%, paying out $4.08 per share over the past year. Dividends are distributed monthly, with the most recent ex-dividend date being August 2nd, 2024. This consistent payout makes TLTW an attractive option for income-focused investors, especially in a low-yield environment. However, it is important to note that the one-year return of TLTW has been minus 15.91%, reflecting the challenges posed by the rising interest rate environment. The fund's performance in the short term has varied, with a 1-month return of plus 1.3%, a 3-month return of, minus 0.6%, and a 6-month return of minus 1.2% since its inception. TLTW has returned minus 7.8%, indicating the volatility and risks associated with the strategy. The fund's beta is 0.27, suggesting lower volatility compared to the broader market. TLTW's portfolio is concentrated primarily in long-term U.S. Treasury bonds, which provide stability and predictability in income generation. The average yield to maturity of the bonds in the portfolio of 4.35%, with a modified duration of 16.68% years, it indicates high sensitivity to interest rate changes. The buy right strategy employed by TLTW aims to generate additional income through premiums received from selling call options. This can enhance returns in stable or declining interest rate environments, but may limit upside potential during periods of rising bond prices. Investors should consider the trade-off when evaluating TLTW for their portfolios. In summary, the iShares 20 plus year Treasury bond buy right strategy ETF offers a unique approach to income generation by combining long-term U.S. Treasury bonds with a covered call strategy. While it provides a high dividend yield and monthly income, its performance can be impacted by the interest rate fluctuations and market volatility. The fund's expense ratio of 0.35% is higher than some traditional bond ETFs, but is justified by the additional income generated by, the call options. For investors seeking high income and willing to accept the associated risks, TLTW could be a compelling addition to your investment portfolio. Long-term growth projections. Growth projections for TLT. Investing $100,000 in the iShares 20 plus year Treasury bond ETF offers a stable income stream from the long-term U.S. Treasury bonds. As of August 2024, TLT has a current price of $95.91 and a yield of 3.75%. Over 1 year, assuming the yield remains constant, the investment would generate approximately $3,750 in interest income, resulting in a total value of $103,750. Over 5 years, with the reinvestment of dividends, the compounding effect enhances growth. Assuming the yield stays at 3.75%, the total dividend income would amount to approximately $20,205, growing the total investment value to around $120,205. In 10 years, the compounding effect becomes more significant. With the same yield and reinvestment strategy, the total dividend income over 10 years would be approximately $45,000, leading to a total value of about $145,000, assuming no capital appreciation or depreciation. Extending this to 20 years, the cumulative effect of reinvestment would be even more substantial. The total dividend income would be around $95,000, resulting in a total investment value of approximately $195,000. After 30 years, assuming the yield remains constant and dividends are continually reinvested, the $100,000 investment in TLT would generate about $160,000 in dividends. This would increase the total value to approximately $260,000, assuming bond prices remain stable. Growth projections for TLTW. The iShares 20 plus year Treasury bond buy right strategy ETF combines long-term Treasury bonds with a covered call strategy, offering higher yields. As of August of 2024, TLTW has a current price of $26.28 and a dividend yield of 15.54%. Over 1 year, this investment would generate about $15,540 in dividend income, resulting in a total value of $115,540. In 5 years, with a high dividend yield and reinvestment, the growth would be substantial. The total dividend income would be approximately $103,200, growing the total investment value to around $203,200, assuming stable bond prices. Over 10 years, the high yield and compounding effect would significantly boost the investment. The total dividend income would be around $255,000, resulting in a total value of approximately $355,000. Extending this projection to 20 years, the high yield and reinvestment would lead to even more substantial growth. The total dividend income would be around $900,000, resulting in a total value of approximately $1 million. Over 30 years, the cumulative effect of the high yield and reinvestment would be dramatic. The total dividend income would be approximately $3,600,000, leading to a total investment value of about $3,700,000, assuming no significant changes in the underlying bond prices. Comparison and considerations. Investing in TLT provides stability with moderate growth through consistent lower yields, making it suitable for conservative investors seeking steady income. On the other hand, TLTW offers significantly higher yields with the potential for greater long-term growth due to the covered call strategy, but comes with higher risk. Investors should carefully consider their risk tolerance, investment horizon, and income needs when choosing between TLT and TLTW. The substantial difference in yield and long-term value growth between these ETFs highlights the importance of aligning investment choices with individual financial goals and risk profiles. TLT, navigating the waters of interest rate fluctuations. The iShares 20+ Treasury Bond ETF offers a safe haven with its estimated U.S. Treasury bonds, but it is not without its own set of challenges. The primary factor impacting TLT's performance is interest rate risk. Long-term bonds are highly sensitive to changes in interest rates. When rates rise, bond prices fall and vice versa, creating potential volatility for TLT. For instance, from 2016 to 2018, as the Federal Reserve increased interest rates, TLT's price dropped from approximately $140 to $114, nearly a 19% decline. Conversely, in 2020, the COVID-19 pandemic led to rate cuts, boosting TLT's price from about $139 in March to over $170 by August. TLT's long duration, averaging around 17 years, amplifies the sensitivity. For every 1% change in interest rates, TLT's price could change by approximately 17%. This makes TLT highly reactive to both actual interest rate changes and market expectations about future movements. Market conditions such as economic downturns or geopolitical instability also play a significant role. During crisis, investors flock to the safety of U.S. Treasuries, driving up TLT's price. Of course, it is also seen as during the 2008 financial crisis and the early stages of the COVID-19 pandemic. However, during periods of economic growth and rising rates, the demand for TLT can decrease, leading to price drops. Historical incidents illustrate these dynamics. In the aftermath of the 2008 crisis, TLT saw significant gains as investors sought safety, while the subsequent economic recovery and rate normalization led to declines. Thus, while TLT provides a stable income stream, its price can be volatile due to the interest rate fluctuations and the broader conditions. TLTW, balancing income with market volatility. The iShares 20+ Treasury Bond Buy Right Strategy ETF presents a different risk profile with its blend of long-term Treasury bonds and a covered call strategy. The strategy enhances income but introduces additional risks and volatility. By riding 1 month out of the money call options on TLT, TLTW generates premium income but caps upside potential. In bullish markets where bond prices rise significantly, TLTW may underperform because the call options will likely be exercised, limiting capital gains. For example, during the sharp bond price increase in early 2020, TLTW's gains would have been capped, unlike TLT, which fully benefited from the price surge. In low volatility or sideways markets, however, the call premiums can enhance returns, providing a buffer against mirror price declines. This makes TLTW potentially more stable in such environments, but less capable of capturing large price increases. The covered call strategy can lead to significant losses in bearish markets. If bond prices decline sharply, TLTW will incur the full extent of the losses on the bond holdings, while the income from the call options may not be sufficient to offset these losses. During periods of rising interest rates, like 2016 and 2018, TLTW would experience both a drop in bond prices and potentially lower premiums from call options due to decreased volatility. Market conditions such as interest rate changes, economic outlook, and volatility levels directly impact TLTW. High interest rate volatility can cause significant price swings, while periods of unexpected market shocks or low volatility may adversely affect the strategy's reliance on call premiums for income. Overall, TLTW offers higher income potential, though its covered call strategy, but comes with increased risk and volatility. Understanding these dynamics is crucial for investors who need to balance the desire for higher income with the potential for greater price fluctuations. Ready to make your investment decisions count? Whether you seek the stability of TLT or the high income potential for TLTW, understanding their dynamics is key. Dive deeper into these strategies and choose the path that aligns with your financial goals. Subscribe now, hit that bell icon, and stay tuned for more insights that can transform your investment journey. Don't just invest. Invest wisely. Invest informed. The choice is yours, and the future of your portfolio depends on it. Join us in mastering the art of smart investing.